So in the first quarter, I pulled data from Fannie, Freddie, and HUD, the three finance agencies. They tend to be the most uh, solid lenders because they have the congressional mandate to maintain liquidity in the multifamily and single family markets. So they're always going to be lending. But they've seen a sharp decline in volumes as well. Fannie Mae volume through the first quarter was down 41%, Freddie 68% down, and HUD 50%. And there's a graphic that I included with a line chart that just kind of shows HUD's volume just tailing off. And HUD follows a fiscal year as opposed to a calendar year. But I kind of tried to keep the data the same. And here's Freddie Mac's volume. It looks like it just fell off a cliff.
Hi, Adam Gower here, founder of Gower Crowd and host of the Real Estate Reality Show on YouTube and all podcast channels everywhere. Thanks so much for joining me today. My guest today is Orest Mandzy, who is managing editor at Commercial Real Estate Direct. He's an old friend and he covers the CMBS industry as his company is owned by TREP. And they are the leaders in the industry monitoring what's going on in CMBS debt. And so he has access to incredible data sources to analyze what's going on in the commercial real estate industry. And he is going to be sharing with us today some slides that he's put together that give a full view of what's going on in the market, looks back historically over the last few months, but also looking forward to see what's going on. You're going to find it absolutely fascinating. To find out more about Orest and Commercial Real Estate Direct, go to the podcast page at gowercrowd.com. And while you're there, be sure to subscribe to our newsletter. It's completely free. And we are covering in detail what's going on in commercial real estate, particularly with a focus on distress, as well as looking at the real estate crowdfunding or online syndication world. We report on everything that we can find online, all there at gowercrowd.com. And of course, if you get the inclination, do please go to YouTube and leave a comment there about today's conversation, about any of the prior episodes that we've had in this series of the Real Estate Reality Show. I'd love to hear from you and would be more than happy to respond to any comments that you have. Right, so now, without further ado, if you are watching on YouTube or watching video, you're going to see some slides. If not, hopefully we cover everything in enough detail that you can follow anyway, but I do encourage you to go to YouTube and watch there. You can go to the website as well to watch this video. Okay, now let's turn it over to Orest Mandzy and his presentation about what is going on in CMBS. Here we go. Orest, super good to see you. Thanks so much for joining me. It's always a pleasure to have you on the show. And I know you've got some slides you want to share with us today. So why don't we jump into that and give me the background to what the quarterly data review is and what we're looking at.
Sure. So we publish Commercial Real Estate Direct. We're a subsidiary of TREP Inc., the largest and most respected CMBS data analytics company. So every quarter we compile a bunch of data from them and us and present it in a format that we send to all our subscribers. And frankly, to just about anybody who asks for it in the industry. So I've put together some data from the QDR and put it in a presentation I thought I'd share with you. A lot of interesting stuff. And this is an interesting period of time in the commercial real estate market, in all markets rather, but we only care about commercial real estate. So let me share the slideshow here. And
sure. And if you can, as we go through this, remember that some people might be listening, Orest,
okay,
and may not have access to the slides. So as you go through, just be descriptive as well of anything
sure,
to somebody who may not see the slides. But go ahead.
Will do. So I wanted to give you an overview of the state of the market generally. So right now we're in a period of kind of high risk. Higher interest rates have made it difficult or challenging for loans that are maturing to get paid off in full. And as you know, and I'm going to go a little here and there, but as you know, whenever there's a risk, there's an opportunity. So gap financing might be the opportunity for folks that want to provide preferred equity, mezzanine debt, and stuff like that. But oftentimes the property's got to be able, the property has to support it, and you have to have a vision for the property for that to get paid off in the end.
Exactly.
What we're seeing are growing vacancy rates in major markets across the country, specifically on the office side. Why that is could be argued. I mean, folks say that it's a work from home trend. But if you have, say, 100 employees and you occupy whatever the space might be, and they're only in the office 3 days a week, you're leasing the space for 5 days a week, regardless. So work from home is maybe a small factor, but it's not the dominant factor. I think a bigger factor was folks during and post-COVID had leased too much space. They're now giving a lot of that back. I think that's probably a big reason. So what we're seeing right now, higher interest rates beget higher capitalization rates. As cap rates go up, property values necessarily decline. The CPPI, which is an index that tracks property pricing, it's a same store index, basically, like the Case-Shiller for residential. That's down. That was down in May for the 10th straight month. That hasn't happened since GFC, the global financial crisis. So it was down almost 7% in 2023 so far, and it's down 12% from the peak. The expectation, and we've reported from a variety of sources on this, is that offices will ultimately see a 35% decline in value from peak to trough. That's the result of vacancy increases, cap rate increases, and a drop in NOI. Many folks, when you have a vacancy increase, what oftentimes will happen is landlords of other properties will be more competitive, right. Lower their rents to lure more tenants in, resulting in an NOI drop. We're also seeing, and we're doing some work on this, on property taxes. Costs are going up across the board, be they utilities, safety issues, and property taxes, for crying out loud. And that's impacting NOI.
We've also heard insurance also is going up.
Insurance is a great example. That's right. That's particularly important on the multifamily side in some markets like the Southeast, which was growing phenomenally in terms of rental rates. So we decided to focus on the office sector because that right now is showing the greatest concern. Office vacancy rates in major markets, total vacancy right now is 19% across the nation, but that doesn't include sublease space. And let's take a few of the markets that we looked at. Chicago, 8.08 million square feet of sublease availability. Before COVID, it was only 3 million square feet. Total availability is almost 25%, which is unbelievable. A quarter of all the space in Chicago is empty.
Yeah.
Washington, D.C., total availability, 20%. San Francisco, total availability, almost 33%. 9 million square feet of sublease is available there. So it's a third of all the office space in San Francisco is empty. Empty or up for lease. And Manhattan, almost a 20% vacancy or availability rate, which is just, these are numbers that we haven't seen since at least the GFC. So what happens when you have higher cap rates, higher interest rates? I called the property, and this was a kind of a fortunate son because the property performed really well. It actually saw an improvement in NOI. And if you have NOI that grows, you could weather the storm pretty well. And this is a great example. And lo and behold, it's a shopping mall. Who'd have thunk it? So this is the Cumberland Mall. It's a premier mall in outside of Atlanta. It's owned by Brookfield Corporation, which, by the way, has given up plenty of shopping malls. Mm-hmm. So in 2013, it generated $16 million of cash flow, and it was appraised at a $254 million value. It lined up a $160 million CMBS loan, which had an LTV of 63%. The debt yield was 10%. Debt yield is just basically the cash flow divided by the balance of the loan. And it gives you an idea of how well the loan can cover, given the cash flow. The coupon was 3.67%, giving it and the debt service was $5.87 million. Given the cash flow, it was well covered. Let's fast forward to last year, or this year, because it just got refinanced. But we only have 2022 data for the property. Cash flow was up 52% to $24 million. The appraised value increased by 45% to $368 million. And so it was able to get a $180 million loan. So now that loan is only $20 million more than the old loan, despite the fact that the value of the property went up by over $110 million. The debt yield of the new loan is 13.5%. The old loan was 10%. So that tells you how, I don't want to say stingy, but I will, lenders have become. They're not willing to lend as much as they were before in all cases. The coupon of this new loan is almost 8%. That's more than double the old loan. But the debt service coverage ratio is, the loan covers very easily. The debt service is $14.17 million, and the cash flow is $24 million. So it's a $10 million excess after debt service. The property, just to give you a sense of how good a property it is, inline store sales were almost $875 a foot. So that's a premium mall. It's among the best performers in the country.
So how does that compare to others on a per square foot basis? What's kind of range that you would expect?
So like a premier mall, anything above, say, $750 a foot is very, very good. Now, mind you, this 874, this property has an Apple store. Apple stores tend to skew the inline store sales. But still, even if you exclude that, it's something like $650, $700 a foot. So it's still a very good mall. It used to be $500 was the barrier, but there are a few malls that do well over $1,000 a foot. There's a big mall that Brookfield owns in Hawaii, Ala Moana, that does about that much. And in Queens, New York.
And this particular property in 2023, what's happened to the value?
So it increased. It went up 45% simply because of the increase in NOI.
Okay, but in the 2023 refinance with debt at 8% coupon,
right?
That doesn't have an impact on what this thing's worth on a cap rate basis.
So, and I apologize, I didn't calculate what the 368 divided by the cash flow would be at 0.3 divided by 368. That's am I calculating it right? It's the cap rate hasn't changed much, but it's still the example shows that if NOI has grown, the risk has been mitigated.
Got it.
You're able to support a lot more debt.
Right.
The issue is, and as I explained that just back there, the lenders aren't lending as much. So the MBA is forecasting a 15% drop in lending volume across the board. So they think that about $804 billion of commercial mortgages were written in 2022. The MBA now expects that to decline by 15%, or whatever the number is, $650 million. Now, their argument is that as rates increase, borrowers will be less inclined to borrow unless they have to. So there's always a refinance churn that takes place, but property transactions have slowed dramatically, so there's no demand on that side. And economic conditions have worsened. So if you don't need to refinance, you're not going to. But some borrowers are still opportunistic. Yesterday, we wrote about the Park Merced apartment property in Los Angeles. The borrower had the property supported I'm going to say $850 million mortgage that didn't mature until 2025. But they still went out and got a new loan I'm told the interest rate is about 5 and change. The old loan was close to 4% to 3 and change, 3.8% or something like that. So they're paying a higher rate, but their expectation was that rates are going to climb even further. So why not get financing today, as opposed to waiting 2 years and who knows what's going to happen in 2 years.
Yeah. Orest, can you hear this blower in the background?
No, I cannot.
Okay, good. So the other thing that we've heard from some of our clients is that they are looking to refinance today, even if it does mean an increased rate, in anticipation of values coming down, because as values come down, the appraised value starts to come down. So they're getting ahead of the curve.
You're 100% right.
Right.
It's not only, well, that's also tied to higher rates, right? As rates climb, values necessarily decline, all other things remaining equal. So they're expecting NOI growth to either flatten, or if it grows, it's going to grow nominally. And so with higher interest rates, the values are going to decline. So it makes sense. If you've got a property and you can opportunistically refinance today, it's probably a smart thing to do. If you're not a gambler. Some people like to gamble. So where are we right now? So in the first quarter, so I pulled data from Fannie, Freddie, and HUD, the three finance agencies. They tend to be the most solid lenders because they have the congressional mandate to maintain liquidity in the multifamily and single-family markets. So they're always going to be lending. But they've seen a sharp decline in volumes as well. Fannie Mae volume through the first quarter was down 41%, Freddie 68% down, and HUD 50%. And there's a graphic that I included with a line chart that just kind of shows HUD's volume just tailing off. And HUD follows a fiscal year as opposed to a calendar year. But I kind of tried to keep the data the same. And here's Freddie Mac's volume. It looks like it just fell off a cliff.
It is extraordinary, that, isn't it?
Yes, it is. Now, but if you look back, and 10 years ago, they were writing about $30 billion of mortgages a year. So they were, over the past 10 years, they've been writing a lot more than back then.
So what's driving that, Orest? It's like it's heading towards zero.
Yeah, it is. It is. So one quarter doesn't make a year. So Fannie and Freddie's volumes tend to be back-ended. So they're backloaded. So their heaviest quarters are the fourth, are the final quarters of the year. Their first quarters tend to be the slowest ones. So because they try to pull deals into the fourth quarter, leaving. So the first quarter is typically a very quiet quarter, but these are this most recent first quarter was an anomaly. They're just volumes have tailed off a lot. I don't think they're going to meet their $65 to $70 billion expectation or planned this year. And here's Fannie Mae also falling off the cliff. So here we compiled some data, again using TREP's data, on mortgages that are maturing before 2024. So within the next 18 months. There are about almost close to $60 billion of CMBS loans that mature within the next 18 months. Just more than $22 billion would not be able to refinance at a 7% coupon. 7% coupon is the prevailing rate right now. I think the weighted average coupon for conduit deals is 6.66, 6.8%. So we're very close to that 7% threshold. A lot of loans are getting done north of 7%. So assuming that a loan would get done with a 1.25 debt service coverage ratio, 22 and $22.25 billion of loans would not be able to refinance at a 7% coupon. So either those loans, sponsors, the owners of the properties that underlie these loans, would then have to raise either mezzanine capital, preferred equity, sell a joint venture stake, or something. Something's got to give, or ponying up some. The cash out refinance is probably not going to happen over the next 18 years.
Months. Yeah.
In most cases, I mean, there are going to be outliers and anomalies, but
more likely it's cash in refinance.
Cash in refis. That's correct.
And what are the asset classes that this table?
So I'm glad you asked because we have them right here. So even at a 5.5% coupon, and we're north of 5.5, these are the numbers that would face challenges. It would not meet a 1.25 x DSCR. So multifamily, 2.6 billion of the $20 billion of loans that are coming due would not refi. That's 13% of that cohort. 17% of all retail loans that are coming due wouldn't meet that test. At 15% of the office and 31% of the hotel loans wouldn't. Really? Now the hotel loans is a small cohort, $20.8 billion loan, so it's kind of it's an oddball. A lot of those loans are also floating rate loans. Hotels tend to go with short-term loans for one reason or another.
That's interesting. So this is a lot of, and this is over the next 18 months. As long as you look at this.
That's correct. And again, this is just a 5.5% test that they would fail. Rates right now are much higher than that.
That's extraordinary.
So here we have the loans that are now in trouble, existing CMBS loans that are in special servicing. Now, loans transfer to special servicing because a large tenant departed, the maturity might be coming due, and they're having difficulties refinancing. They might have failed some sort of trigger, some sort of test, a debt service coverage test, a big occupancy test, or something like that. There's some issue that increases the risk of that loan defaulting. So I highlighted the office section because we've seen almost a 67% increase in the volume of CMBS loans backed by office properties that are in trouble, meaning that they're in special servicing.
Right, and that's in the last 6 months, basically, from December 20.
That's right, from the end of last year through May. That's correct. Yeah, that's overall, the volumes have increased by 18%, and that's driven by that outlier, the office sector. Almost $11 billion of loans are now special servicing. Now, that's an opportunity for certain investors, right? For every downside, there's an upside. Someone could view that as a potential investment opportunity to let me go in there, inject some equity into this property, take a piece of it, and help work it out.
You know, this is interesting. When you look at the hotel numbers, that's actually down 6%. That's gone into special servicing. And that's probably got a lot to do with the fact that the economy is still humming along.
Yeah.
Right? There's full employment. People are still spending.
Yeah, that's correct.
Right. And there's also this rebound from COVID. Everybody stuck at home.
That's right.
You know, just running around, taking vacations and traveling. So that makes sense. Retail is also interesting at almost 3% down. Also spending. But what's really interesting to me is multifamily, because this is the darling of all real estate investment. You've seen 33% almost increase. It's relatively small in absolute numbers, but still, what's going on with multifamily?
Yeah. So when you have small. So $1.9 billion of loans in special servicing, multifamily loans in special servicing is a relatively small number, 48 loans. So there's a lot of noise in there. There's a lot of loans that go in and come out for one reason or another. In recent weeks, there was a property a loan against a large property in New York called the Air that has some issues. Part of the issue is higher expenses. Its operating costs have skyrocketed 20-30%, and that's kind of pinching its ability to pay rent. Even though rents have skyrocketed at the property, they haven't kept pace with the increase in operating expenses. But again, that the multifamily number has a lot of noise in it. We'll see from a month-to-month basis that number goes up and down as loans come in and then they get resolved. So it's I wouldn't be too concerned about multifamily, although this year we're probably going to see 500,000 units come online. So there could be, the 11% rent increases that we saw last year aren't going to happen this year probably because supply and demand
when you
is the reality.
Just help me understand the job of the special services, right?
So the
we both know well, but please describe what do they do and what does it mean to resolve a loan
So
in a CMBS.
I always think of special servicers, and I hope not to insult anybody, but they're workout guys. They're workout special guys and gals. They're workout specialists. So a loan gets into trouble or might be getting into trouble. They get on the phone. Okay, we lent you money. Now pay it back. Sometimes it's just that. I'm sure it's always more than that, but it could be an issue that the borrower might have had, and they try to figure out what's going on and get paid. So that's the resolution.
But they restructure. Do they restructure loans as well?
Yeah, they do. They have the authority to do that. So we've seen loans get extended. They might get a couple of year term, but nothing's free, right? There's no such thing as a free lunch.
Right.
So if a lender is going to give you, especially if you've got a loan with a coupon of with a 3 handle, if you want a year or two, well, it's going to cost you. You got to pony up a couple of $1 million or so. And in fact, we've seen that happen. That you can't extend and pretend without paying a penalty, because you can't extend and pretend into a higher coupon, higher interest rate environment. That just doesn't work. No one wins but the borrower in that case.
Right. And inside a CMBS tranche, the rules are different than they are for a bank, aren't they? For a bank, there are different discussions. There's different fiduciaries, and how does that work inside?
Yeah, so in CMBS, it's highly structured. So there are specific rules on what happens when and what triggers what. So when a loan goes into special servicing, it's an event, and the special servicer now has to get paid. So bondholders typically, so the bondholders at the top, they're getting the interest payments. They have senior priority to payments. They don't want any of that. They want, just give me my money, just pay me my coupon, and make sure all the loans work. But the reality is sometimes loans don't work. And it's incumbent on the special servicer to maximize proceeds from any soured loan for all the bondholders.
And will they also sell those loans? They will sell those.
They could. So when the loan goes into special servicing, first thing they do is order a new appraisal to determine what sort of strategy to implement. If the value of the property, of the collateral property, is declined substantially, they might say, well, you know what? The only way this is going to work is if we sell the loan, or the best outcome for the loan is a sale of the loan or sale of the collateral property. But then you have to get your hands on the collateral in a judiciary state that might be costly. So maybe you try to get a receiver in place and then order a sale of that, or try to negotiate a deed in lieu. So they have fun jobs when the market turns south.
Yeah.
And I'm being facetious. It's not fun for
well,
anybody.
It really depends on your perspective. I actually went through this with. I was at a bank during the global financial crisis, and we did a lot of workouts and dealt with receivers and special services. There was a lot of. That's exactly what's happening now, and it's not something that we've seen for a while.
Yeah, that's right. But luckily the special servicers, and there are, I'm going to say about 12 or 14 special servicers that are quite active. They've got proven track records. They've been doing this forever. The newest player is Rialto, and they've been around for over 12 years. So, CW Capital has been around since. If you go back to their previous iterations, Creamy May and folks like that, they've been around forever. So, the industry's in good hands. These are highly expert companies and the people that work at them.
All right.
The big difference between banks and CMBS is you have multiple fiduciaries, and you're a fiduciary for multiple parties in a CMBS transaction.
So it's harder to resolve loans.
Yeah, for sure.
Everybody.
And I think I have one or two more slides, a couple more here. Briefly, CMBS loans and special servicing equals 6.1% of the entire CMBS universe right now. And
actually, jump back to that, will you? Sorry, back to that.
Sure.
So it's 6 point. What are we looking at there? March 20, it spiked dramatically.
Yeah.
And
Yeah.
how does this compare to the global financial crisis?
So during the global financial crisis, if I'm not mistaken, and I wonder why that's 50%, but it was a 12%, roughly 10 to 12% of the entire CMBS universe was in special servicing.
And it's trending up, I see.
It's trending up, that's right. And to be expected. I mean, as loans are coming due in an increasing interest rate environment, we're going to see more trouble. Will it go up to 10%? Time will tell. I don't think so, because the workout machine is going to start churning. They'll spit them out as new ones come in.
And is that anticipation, do you think, that the rate environment will change and that will dramatically alter the dynamic of what's going on? People are extending, not pretending, but anticipate. Stay alive till 25.
That's right. Yes. The biggest issue there is you have to have capital in order to survive.
Right.
If you've got a $100 million loan against a property that's now worth only $110 million, you're going to lose it unless you're ponying up additional capital.
Right. And that can be good money after bad, depending.
Yeah. That's right. Yeah, it depends what you own, where you own it. Because it's really, particularly in the office market, it's become really a tale of two cities. If you've got a trophy property, if you look at SL Green's recently completed One Vanderbilt building, that thing's generating like $150 a square foot rent, and it's full. And then 2 blocks away, a building's leasing at $80 a foot, and it's half empty.
Yeah.
So it's
well, that was a term that I think you're speaking to now that was on a slide earlier. You talked about commodity office. Yes. What is commodity office? This is the area that you think is going to be worse hit.
Yeah. So it's picture a city, and I'll say New York because I'm kind of familiar with it. But so a middle block building was built maybe in the 70s, 80s, lacks amenities. It hasn't been upgraded in 10, 15 years. There's nothing special about it. Whereas then you compare that to any building, frankly, in the Hudson Yards neighborhood, or Vanderbilt Square across the street from Grand Central Terminal. It's highly amenitized. It's really designed for tenants and their employees. So people want to go to work there. Companies like to be headquartered there or have their offices there. It's and a lot of these commodity office buildings, the argument is, well, they could be redeveloped into apartments. I would argue that most of them can't.
It's not so easy. Exactly.
It's not. It's if you have one of these big middle block buildings with limited light, you can't convert that into apartments.
Right.
Who knows what's going to happen.
You also talk about highly amenitized. You know what it makes me think about, Orest, is these. I think of these black and white images of typing pools.
Yes.
From the whenever the 50s, where it's just huge rooms with people everyone was just a little machine.
Yep.
Cog in the machine. And when you talk about amenitized offices, you're talking about something that is just pleasant to be in. You don't feel like you're part of a machine. You feel like, it's home, or it's comfortable. It's a nice place to be. It's very different. And this is something that's also interesting. You talk about a tale of two cities, because I speak to one of our clients in Florida, Feldman Equities, actually, and he talks about amenitizing office buildings, and that is the critical difference. If you have and
the question is, what amenities do you want to add? I mean, is it just a fitness center? I don't know. Does that do the trick? I don't think so. I always think of the Bloomberg's building on I forgot what street it is in Manhattan. Everywhere you go, you could pick up a banana and eat it if you want, because there are bananas all over the place, and they've got fruits all over the place and cereal boxes and stuff like that. So it makes the employee sort of feel at home almost.
Yes.
I'm glad I don't work there, because I'd weigh 250 pounds, and I don't need that.
Exactly. All right, what's your next slide? I know you've got another slide here.
And this is my last one. So we've been doing some work on analyzing how public markets value office property specifically, and office companies, office owning companies, and how private markets do. The public market is heavily penalizing office owning REITs. The implied cap rate for all REITs is up 162 basis points over the past 12 months. The office owning REITs, their cap rates are up 250 basis points. Now, private market cap rates are 17.3% lower than public market cap rates. Meanwhile, private office deal cap rates are 27% lower than what the public REIT implied cap rates are. So either the public markets are overshooting the target, or they're predicting what will happen. We don't know the answer to that yet. But in time,
could it be that private markets are wrong?
It could very well be, because the private market cap rates are very backward looking. And a lot of deals just aren't happening. There's a lack of price discovery. If you don't have to sell, you're not going to.
Right.
And then if you have to sell, you're a distressed seller, so it's going to be a sort of an outlier almost. It's a tough time right now, but the public markets are saying that the office sector still has a way to decline.
That's really interesting. So this idea that private market. So what is causing that difference? What is then what drives that imbalance?
It's all a matter of liquidity. But public REITs are highly liquid entities, right? If you're sour on the office sector, you're just going to sell the stock. The stock price will decline, which will then result in a higher cap rate for the valuation of the company. Private markets, nobody has to transact unless they're forced to.
I see.
So it's simply a lack of price discovery on the private side.
Interesting. And what does SLG stand for on this page?
Oh, SL Green. I apologize. So they're an office owning company, office owning REIT. They're among the biggest landlords in New York City. And the analysis that we've done show that their implied cap rate is up 40% over the past 2 years. Whereas New York office cap rates are up only 30%. So we're not sure if their stock price is indicative of what office value should be, or whether or is it a buying opportunity? Do you buy SLG stock because it overshot the target?
Yeah, exactly. So is this a good buying opportunity?
Yeah. It's I'm not saying buy it by any stretch of the imagination, because I don't know anything about this stuff. But,
but these kinds of cap rate increases, up 40%, even up 30%, that's value decimation, really.
It boggles the mind. Did you look at these numbers and you have to say, let me calculate this again?
Yeah, the reality is that it just strips equity out of these assets.
Yeah, all you have to, SLG is a very, very well-run company. They have some of the best buildings in the city. Their stock price peaked at like $85 a foot. Now it's in the 20s. So it's just been clobbered because it owns office properties in New York City.
Right.
New York City has a 19% vacancy rate.
Yeah. It's interesting, isn't it? So where do you think so what do you think what are we doing? Okay, look at this. It's amazing how much time we spend. Orest, it's such a pleasure to talk to you always. Let's go back to just thee and me. So I'm going to stop sharing so you and I can just.
Okay, sure.
So where do you think this is going to go now? I mean, we're now in July, almost July 2023. I don't normally like to date stamp these things, but it's important. What do you think is going to happen over the next 6 to 18 months in terms of opportunities for buyers in the market?
Yeah, I think so. Within the next 6 months, we're not going to. I have a sense we're not going to see too much opportunity. They're not going to. The opportunities won't materialize. You have to take a longer view. There's a lot of capital sitting on the sidelines waiting for these opportunities.
Right.
They're not that capital is not getting deployed for the most part. I mean, some of it is, but it's really hit and miss. There's not. This isn't like the S&L crisis where all of a sudden everybody was selling portfolios.
Right.
That said, we have seen a couple portfolios trade. Pac Western did sell $5 billion or agreed to sell $5 billion to Kennedy Wilson,
Right.
which then retraded some of it and stuff like that. But and those were all performing loans. I mean,
They
the
were
haircut
construction
was
loans, weren't they?
yeah, that's right, that's right. Yeah, so they took
sold them
that
at a
risk on.
slight discount. They sold them at a slight discount. It was a
That's
very
right.
play from
That's right. That's right. And they don't have to fund the future funding liabilities off their balance sheet.
Right.
So for them, that was a great deal. We're not going to see many of those deals within the next 6 to 10 months. This is going to result in opportunities, I believe, in very targeted opportunities. It'll be one here, one there, one there. It's not going to be, Continental Illinois selling, $400 million in mortgages. It's highly unlikely that will happen. I think the good thing that we're facing now is following the GFC, lenders were very, very conservative relative to prior to that. So loans were written at 50 to 60% LTVs. Mind you, those LTVs are much higher now because property values have declined.
Right.
But they're not, they're no longer 180% of LTVs. They're not that.
Right, from the GFC. Now, this comment that you make about capital being on the sidelines, you mentioned this last time we spoke.
Yeah.
It's on the sidelines, it means that it's not in the it's not in the market, which means there's liquidity issues. But what do you think is driving that? Is that actually, let me ask you this question directly. If the Fed were to start reducing rates, which doesn't seem likely anytime immediately soon, but if they do you think that capital will start flooding in, looking for opportunities in anticipation of values going back up as interest rates come down?
So I don't know if the capital expects values that will not be deployed with the expectation that values will increase. It'll be deployed because, okay, there's a 30% vacancy in this building. We could improve that to 20% or to the market level because we have capital that we could invest in the property. I think those are going to be the opportunities that we'll see. I think a lot of the properties that are going to have problems are because the sponsors are strapped. They don't want to put good money after bad in upgrading a property that's maybe a B property in an A market or something like that.
Now, you focus on CMBS, and we should wrap up, but you focus on CMBS. How do you think and you mentioned, I think you said 70% of commercial loans are CMBS, is that right?
No, it's 17%.
17.
So it's the biggest lender group is the banks and thrifts.
Right.
And which brings up an interesting point because by nature, they should be writing floating rate loans. Those floating rate loans are looking at if their benchmark rates are not capped, those are looking at substantially higher interest rates than they were as recently as 8 months ago.
And banks and thrifts, they account for around 50%, don't they?
That's correct. Yeah.
And so the story on that side of the equation, not something that you focus on, is very different.
Yeah, it is. It is. A lot of that'll shake out one way or another. The bulk of their lending should be construction financing, right? Because those are by nature short term. They get taken out by permanent lenders, be they insurance companies, CMBS, or the housing finance agencies. I didn't even mention the alternative lenders, the mortgage REITs. They provided almost no capital to the loan market in the first quarter. 5 mortgage REITs didn't write a single loan, which they're in the business of writing loans. It's just they don't want to catch a falling knife.
Exactly. Orest, thank you so much. Like I said, we should definitely revisit as things change. Do you have any more reports on the horizon coming out over the next few months?
Yes, so we're, as I had mentioned, we had started compiling the public market cap rate data. It's data we're putting together using a lot of assumptions, a lot of internal assumptions. We're culling from the TREP database to make better assumptions. But it'll give us an idea of the delta between the public and the private markets in terms of property valuations.
Yeah, that's really interesting. What exactly you say it's the bid ask. I also wonder though if it isn't that in the private markets you don't have analysts, whereas in the public markets you do, and so they must drive it to some extent. No, what do you think?
Yeah, well, you're right. I mean, and the analysts drive the buying and selling, right? If they say, well, sell this stock, which is to do, this stock gets clobbered, and that results in an increase in cap rate.
Yeah, whereas you don't have that same kind of volatility
That's
in
right.
the private markets. So maybe the private markets are just lagging.
Yeah, could very well be, and that's the question that we can't answer.
All right, and we'll know
in 2 years. In 2 years, we'll be able to say, it was the private markets that were lagging, or it was the public markets that overshot it.
So how are we going to place our bets today?
Yeah.
Orest, thank you so very much as always, Orest Mandzy. You are just to your title. I get this was your managing editor, CRE News. Is that right?
That's correct. Of Commercial Real Estate Direct, which is www.crenews.com. Yep.
It's just always such an enormous pleasure. Thanks so much for putting together this slideshow today.
Well, thank you for having me, Adam. It was a pleasure. Thank you.
That was Orest Mandzy, who is managing editor at Commercial Real Estate Direct, talking about CMBS. Very interesting. A relatively small part of the commercial lending world relative to banks and thrifts, but nevertheless a good indicator of what is going on. I'm particularly interested to see this disconnect between private and public markets with cap rates. That's it for today's episode. Do go to the gowercrowd.com website to find out more about Orest, find the podcast page for today's episode. And if you have the time, please leave a comment on the YouTube channel, which is youtube.com/gowercrowd. You'll find the episode and all prior episodes there. Thank you so much, Orest. Thank you so much for joining me today. It's always an enormous pleasure to see you. And thank you, dear viewer, for joining us and spending your time with us. Hope you found today's conversation as interesting as I did. And I look forward to seeing you next time on the Real Estate Reality Show. For now, this is Adam Gower, signing off.